Tapering by the Fed is the big discussion in the marketplace today. When will the Fed start tapering? They've announced that they will start tapering soon. This is going to be the third try for the Fed to taper. Let's start at the beginning. At the financial crisis, the Fed started expanding its balance sheet very rapidly. And the balance sheet went from $860 billion in 2007 to today's number of $8.6 trillion today. That's a tenfold increase in a little over 14 years. This is a massive increase in the Fed's balance sheet. Part of this was during the financial crisis, and then the Fed announced a program called Quantitative Easing after the financial crisis, where they continued to provide liquidity into the market. And then they announced that they would start to taper this, and this announcement was made in 2012. In 2013, they actually attempted to taper, and we had the taper tantrum. Taper tantrum sent rates up sharply, very quickly, and the Fed reversed course and actually stopped tapering. What is interesting is Fed Governor Fisher in 2012 said that once you enter quantitative easing, you're never going to be able to leave. He dubbed it the Hotel California moment. You can check out anytime you want, but you can never leave. This has truly been the case. The Fed tried to leave quantitative easing in 2013 and backed off. And then again in 2019, before COVID, they started tapering again and had modest tapering success, and the markets were actually handling that fairly well. But as we all know, COVID hit and the Fed began expanding its balance sheets again rapidly to today's number of $8.6 trillion. The discussion with tapering today is also going to be the third try. The markets have become addicted to low interest rates and plentiful liquidity. If the market has to bear higher interest rates, competition for stocks, competition for other items such as cryptocurrencies will go up with interest rates going higher. This will generally drive the values of those assets down. That is historically the way the markets have worked. If interest rates go up, the value of other assets go down. That has been the historical nature over hundreds of years. We believe that tapering will probably not go through this time as well. The market is too addicted. The Fed is going to be faced with a real problem. Do they let inflation continue to run out of control? We had a 6.2% year-over-year CPI number. That is a very hot number. That's the hottest number since 1991 for the inflation index, CPI. This is way above what the Fed wants. The Fed wants a 2% inflation number. It's very unlikely that that is going to be able to occur in the near term. Inflation has generally been a monetary phenomena. When you go back over the centuries, governments have produced more money and created inflation for centuries. Every empire across the globe has done so near the end of their empire. This does not mean that the U.S. empire is coming to a close, but it does probably mean that we're going to have high inflation. Our Federal Reserve balance sheet has gone from $860 billion to $8.6 trillion. It's up tenfold. That is just an unbelievable increase in monetary power. That generally spills over into inflation. We're beginning to see it today. The Fed is trying to argue it's transitory. It does not look like it's transitory to us. It's spilling into all sorts of goods. It's also spilling into services, into labor. It's very hard to roll back inflation once it starts spilling into the mindset of the consumer and the worker asking for higher wages to keep up with this inflation. The other item that has been very much an element in the need for quantitative easing is the U.S. federal debt, which has also exploded. The federal debt is now up to about $28 trillion. That's just the official debt on the balance sheet. That doesn't include Social Security and Medicare unfunded liabilities. That's a huge number as well. That's bigger than the U.S. economy at $22 trillion. So we're in a situation where the U.S. debt has exploded. The Fed has enabled it by buying a bunch of U.S. bonds and keeping interest rates low. But the flip side of that is they've produced all this liquidity that's gone into the market. The past 10 years, it's gone mainly into financial assets, also into real estate, also into cryptocurrencies. So you haven't seen it show up in the real economy and inflation numbers, but that seems to be changing. That liquidity seems to be spilling into the real economy as shown by this 6.2% CPI number on the inflation. We believe this is not transitory. We believe that the Fed is facing a real problem. And when they start to try to taper and interest rates start to move up considerably, I think they're going to be faced with the dilemma of do they let the economy and asset prices roll over, or do they let inflation run away? This is a very tough question, and we're going to have to watch it very closely. My guess at this point in time is that they will lean toward letting inflation run. This is Ben Halliburton. I hope you have a great day.